Bismillahirrahmanirrahim. Hussain Qazi here, SBR students. Once again, a very warm welcome to my session. First of all, we need to set an agenda of this session. The content we have been discussing, IFRS 9 financial liability. Under this content, one of the topic we need to cover, the loan modification. Loan modification. Loan borrowings modification. We will cover this topic with this sequence. The sequence is, number one, we will cover the meaning of loan modification. Then we will cover a term substantial change. Then we will cover a test called substantial test recommended by IFRS 9 for loan modification. That's 10% substantial test. Then we will cover the accounting of loan modification by IFRS 9 and then conclude our session with a comprehensive example. Comprehensive example. So let's start the session with an example to develop your mindset. With an example to develop your mindset, what is about the topic? Basic example. For example, you are an entity, you have taken a loan from bank. Very simple. Duration 5 years. So you are a borrower. Your position is a borrower. Liability, loan, balance sheet, borrower, loan payable, financial liability. Terms of the loan, $100,000 amount, $100,000 principal amount. Your commitment to pay interest on yearly basis, year 1, 2, 3, 4, 5, 10%. And you will, with this term, you will repay your loan after 5 years, the amount $100,000. Okay. For example, year 1, everything is all right, no worries, you have paid the interest. Year 2, before the year end, you as entity facing some crisis about the repayment of interest, repayment of loan, all these things. So your management has started the negotiation with the bank. And something is finalized at the reporting date, at the end of year 2. Something is finalized with this negotiation. For example, the negotiation is finalized that the loan duration has extended by 1 year. So originally, at the end of year 2, the remaining time period was 3 years. But now, the revised time periods become 6 years. So the terms in terms of duration is now become changed. Terms may be, the change of terms may be the interest rate, maybe the adjustment of interest rate. It depends on negotiation. Increase in interest rate or decrease in interest rate, it depends on negotiation. Maybe the amount become also changed. So our topic is not about that. Why negotiation is made and what terms has become changed. Our topic is that if the terms has become changed, that is called loan modification. Number one. And our concern point is that how to account for this? How to account for loan means borrowing modification. So I hope with this example, you have developed your mindset. What IFRS 9 says about the definition of loan modification. IFRS 9 says that modification of loan arises if the terms of an existing loan, that's financial liability, are changed. Terms of an existing loan, financial liability are changed. Terms includes duration, includes interest rate, includes principal amount. Change means increase or decrease. Interest rate increase or decrease. It depends on negotiation. Another possible situation is that if the existing loan is exchanged for new loan with existing lender. It may also possible. Not the change in term, but the exchange of previous loan with the new loan. And with the corporate world, it's a very known matter. Exchange of new loan. So exchange for a new loan also under the scope of loan modification. So number one, accounting standard definition of loan modification. You can write it with your own wording, sir. Modification of loan arises if the terms of the existing loan financial liability are changed, or if an existing loan financial liability is exchanged for a new loan with the existing lender. This is a typical definition. Now, according to agenda, after the definition, we need to understand a very important point that's called substantial change. Sir, why substantial change? Why you are not discussing the point accounting? Wait. The accounting of loan modification is actually based on substantial change. The term substantial change. Accounting standard IFRS 9 says that if modification happens, if loan modification happens, first of all, you need to assess the change or modification, it's substantial or not. Substantial, yes. Substantial, not. Yes or no? Because if the modification with the, if we identified with the assessment that substantial change is higher, or yes, the accounting is different. If no, the accounting is different. So first we need to assess substantial change. So if we are going to assess the substantial change, and if the modification is becomes substantial, that's called yes, we will declare the accounting of loan modification called extinguish accounting. What is that name? Extinguish accounting. If the assessment says that substantial change, no, the accounting name is modification. Don't mix this modification name with loan modification. This is a terminology. So students, the whole system, the whole accounting is based on the assessment of substantial change. The assessment of substantial change. But the point is that it's very irritating. Sir, how to assess substantial change? Don't worry. Accounting standard has provided complete guidance to assess the substantial change. That is called substantial test. So number one, loan modification definition. Number two, assessment of substantial change. Yes means accounting of extinguish, no means accounting for modification. Number three, how to test substantial. Substantial test name is 10%. Substantial test name is 10%. Yes, this is 10%. Mr. 10%. 10%. Okay. So how to assess this 10%? We need to calculate the difference. Wait. We need to calculate difference when? At the point of negotiation. When the negotiation has done, when the modification has done, for example, with our example, at the end of year 2, at the end of year 2 or reporting year 2 or the modification date, at that point, first we need to calculate the difference between the carrying amount of original loan. That is simple present value cash flows under original arrangement. This is called amortized cost method. Simple. Carrying amount of loan by amortized cost method. So calculate the difference between present value of cash flows under original arrangement. That means amortized cost of our original loan. Compare with present value cash flow under new arrangement. present value cash flows under new arrangement. Plus, if you have made any fees or transaction cost, and paid any fees or transaction cost for modification. For example, present value of future cash flows under original arrangement, that is amortized cost method. That's a normal accounting of the financial liability, is 100,000. 100,000. Hold on. Before comparison, first need to calculate this Mr. 10%. I'm sorry, this 10% threshold. What I said, the word threshold. For example, the amortized cost of the original loan is 100,000. So what is the 10% of 100,000 is 10,000. Sir, what is this 10%? It's mentioned by accounting standard. The 10% term as a threshold by accounting standard. So first the amortized cost method and sort out the figure of 10%. That is the threshold, 10,000. And then calculate the present value of cash flow under new arrangement, that is 115,000. 115,000. 115,000. So the difference between, right side, the difference between the original loan amortized and the new loan present value of cash flow is 15,000. This is 15,000, 15. And this is greater than threshold. Greater than threshold. TH is a threshold. Greater than 10,000. Greater than 10,000. If it's greater than 10,000, that means it's substantial yes. And if yes, it's called extinguish accounting. What is the accounting of extinguish modification? I will discuss, don't worry. On the other hand, if the present value cash flow under original arrangement is 100,000, threshold is 10,000, but the present value cash flow under new arrangement it's 108,000. That means it's 8,000 is less than threshold, less than threshold, less than threshold. This is called modification. This is called modification. So that's a point. Do remember, to assess, only to assess the substantial test of 10%, only to assess, not for accounting. Always use discount rate, with original EIR. What does that mean? Recall my example. At the end of second year, the modification happened. So at the end of second year, maybe the market value of interest rate become changed, but don't use the market value of interest rate at second year. To assess the substantial test, use the discount rate of the original bank loan effective interest rate. That's the 10%. Why? It's not the point here. It's a point of concern. It's a point of concern for IFRS 9, and this is the rule. Leave it about the reason for the time being. So once again, the point is that all accounting comparison, it's loan modification accounting is based on either the modification extinguish or modify. That's a point. And this is based on 10% threshold point. That's a point. Now, make it very clear once again. IFRS 9 loan modification is based on substantial change. If substantial change, yes or no. If yes, that's called extinguish. No means modification. And what is the substantial test? Calculate the difference between the original loan amortized cost at modification date, compare with present value cash flow under new arrangement. For example, 100,000 and calculate the threshold, compare with 115,000 If it's more than, the difference is more than the threshold, that's called extinguish. It's less than the threshold, that's called modification. Always use the discount rate using or original effective interest rate for the substantial test assessment. It's all about extinguish or modification. That's based on 10% threshold. Now come on, accounting treatment. What is the accounting? So that means whatever you have done, it's about the filter. First, meaning of modification, then filter out if it's about the extinguish or it's about the modification. Extinguish, that's greater than or equal to the 10% of threshold. Maybe you people have a confusion that, sir, it's about more than and less than. What about equal to? If the difference is equal to 10%, so greater than or equal to the 10% of threshold, we will apply extinguish accounting. If it's less than 10%, we will apply modification accounting. Okay, sir, do let us know extinguish accounting. Develop your mindset. Extinguish means the modification is substantial. It's some significant. So here accounting standard says that number one, you need to de-recognize the original liability. At modification, you need to debit the loan, original loan, and credit the new liability at its fair value. Original liability debit, new liability credit. Any difference is recognized in a statement of P&L. And if you have paid any other fees at modification date, charged to P&L. Very simple. Sir, what about subsequent? So subsequently, the loan recognition at modification date, subsequently apply the amortized cost method with the new effective interest rate. Means loan amortization over the remaining time period with new effective rate. Because previous loan you have de-recognized, new loan with new fair value have new fair value as new loan with new fair value, you have now become recognized. Modification. If modification means less substantial, so if it's the modification is less substantial, so number one, not to de-recognize the original liability. The original liability is still to recognize, still continue to recognize. Number two, whatever the change has made, so you need to restate, you have to restate the original liability. If change in a manner to increase the liability, that should be credited. If something about decrease in liabilities, that should be debited. So original liability is restated to the present value of the revised cash flow with any fees paid being deducted. Number three, any difference is taken to the profit and loss. Of course, because the previous liability not have de-recognized, so subsequently, obviously, amortized cost method still continue, but with original effective interest rate, not any new effective interest rate. That is the accounting. All I have covered with all the content I have covered, but now it's time to discuss one example to make more clarification of this concept. Okay, so let's start an example. Read this example carefully. Read it carefully. Read it carefully. 1st January X1, Ariel borrowed 20 million from bank. The terms were as follows. Interest rate 5%, payable annually in arrears. Okay. Issue cost $270,000 were incurred. That's a simple loan. Loan is repaid in 3 years' time. 3 years, 1st January X1 to 31st December X1, that is 3 years. Effective interest rate, it's 5.5%. That is IRR. It's not equal to 5%. That 5% is the coupon rate. 5% is coupon rate. But it's more than coupon rate because of issue cost and these things. Are standing at 31st December X1. Are standing at 31st December X1. 1 year has gone. After 1 year, the present value of cash flows relating to original loan, the present value 19.815 thousand. Amortized cost math equal to loan carrying amount. That is amortized cost. That's very simple. It's not about loan modification. But read this. On 31st December X1, same at first year end. After the first coupon payment was made, that the company has paid the interest with the original interest rate. Loan was renegotiated with the following terms. Loan was renegotiated with the following terms. What is the term? The new loan present value of the loan 20 million equal to the loan's fair value. Loan's fair value. Transaction cost 1.2 million means transaction for the negotiation of the loan 1.2 million. Repayment on 31st December X4. Original repayment date 31st December X3, but now it's 31st December X4. So that means the duration of the loan has extended, and interest rate, it's 7%. Interest rate has also extended, but not compulsory. Always the interest rate extended, interest rate become increased. It's not compulsory. It may be possible that interest rate become decreased. It depends on negotiation. We will not comment why this happened. Instead, we have to cover the accounting. The terms with respect to loan, term with respect to duration, term with respect to interest rates has now become changed. But do remember, principal amount is still same. 20 million original loan, 20 million revised loan. Still same. That's the point. Now the point is that how will the renegotiation will be accounted by Ariel as at 31st December X1. This is what the example. Now come on. It's time to attempt this question. Okay, yes. That is the example. Yes, come on. Number 1. We have to make, before applying the loan modification accounting, first of all, we need to make a substantial test. At what date? At the date of loan modification. At the date of loan modification. And that is 31st December X1. That is 31st December X1. Just a minute. Yes, 31st December X1. So calculate the substantial test. Yes, first of all, the point is that we need to calculate the difference between what? Present value of carrying amount of the original loan. Carrying amount of the original loan means simple, the amortized cost value of the original loan. And what is this value? That is 19.81 19.815. This is the value. Yes, 19.815. But do remember that once we calculate the carrying amount of the loan or we identify the loan, we have to pick the threshold. The threshold of what? 10% of the original loan carrying amount. That is 1981.5. So whatever the value and whatever the difference we will identify here, the difference we need to compare with this 1981.5. If the difference equal or greater than this 181.5, that's called extinguish. We will apply extinguish accounting, otherwise modification accounting. So now it's time for the working for this present value future cash flow with the new negotiated term. Now we need to make a working. Come on. Working for present value of future cash flow with the new negotiated term. One by one. Are standing at 31st December X1. If we wanted to assess the substantial test, so we need to cover the cash flows including the transaction cost, even that cost have already paid. So first thing is about 31st December X1. 31st December X1. And that is year 1. Yes, that is year 1. And this is about the fees or the transaction cost. That is the transaction cost. And what is the value of this transaction cost? That is about the 1200. That's 1200. Thousands, huh? In thousands. Yes, of course, this is the now figure. So this is 1. It's not the present value. Sorry, it's year now, not 0. 31st December X1, it's now. Then 31st December X2. How much the remaining time from 31st December X1? 31st December X1, 2, 3, and 4. 31st December X1 is now 2, 3, and 4. Remaining time periods is 3. 1, 2, 3. That is the point. Then interest plus redemption. So how much the interest with the revised method? That is 7%. That is 7%. That is 7%. 7% of 20 million is further 1400 plus 20,000. Now calculate the discounted. This is original effective interest rate. Original effective interest rate. That's 5.5% is equal to 1.055 power minus this. Now calculate quickly. 1200 multiply by this. That is 22,009. We are not discussing something accounting here. Huh? We are not discussing the accounting here. We are discussing the substantial test and calculating the difference and calculating about to assess its substantial yes or no. So this is the total amount. This is the total amount. This is the total amount. I hope it's clear, huh? So now it's a total amount, huh? This amount is a total. And now calculate the difference. The difference is 2194. And compare this difference with 1984. So that means the difference is greater than threshold. So we will declare the loan modification with extinguished accounting. Loan as extinguished accounting. This is the right way. This is the way that recommended by IFRS 9. Is this modified or extinguished? It's extinguished accounting. Now, sir, do tell us no. What will be the accounting? Do remember accounting at 31st December X1. That is the day of accounting. Number one, the day, this is about de-recognize the previous liability. So your original loan, you need to debit the financial liability, the original one. Debit. And credit the financial liability with the new one at fair value. At fair value. Fair value at negotiation date. And what is this? This is what about the fair value. It's mentioned the par value of the loan means the carrying amount of the loan 2 million, 20 million. It's equal to the loan fair value. If the loan fair value it's not given in the question, some information will provide by the examiner where you need to calculate the fair value in terms of present value, future cash flow, all these things. So that is about the fair value, that is 20 million. 20,000. Any difference here, difference is debit or credit. Any difference here, difference is debit, is P&L. And you need to charge. That's equals to 180. Sir, what about this? Is called loan extinguishment. Sir, what about the transaction cost? In this case, the transaction cost of modification, modification. In this case, the transaction cost of modification immediately charge to the profit and loss account. Profit and loss account charge and credit the bank. How much the value? 1.2 million. That is 1200. Ideally, this should be the transaction. Subsequently, new loan with amortized cost method. Amortized cost method. AMC amortized cost method. With the new effective interest rate. And the new effective interest rate here, the 7%. You can make a schedule accordingly. Opening balance. For example, if someone says to make extract of X2, so number one, year end X2 opening balance, that's simple. Opening balance is 20,000. Interest expense, that's 7 million. Oh, 7%. Interest payment 7%. Year end 20,000. That's simple. Sir, if this point examined with the SBR exam, how to write? You can write the answer in this manner. For example, with this answer, you can start the term of the new loan need to be assessed to determine whether they are substantial. And you can refer this working with your spreadsheet. You have to make the working with the spreadsheet and then work out with modified or extinguished like we have covered with our example. Present value of the original cash flows, present value new cash flows difference. The loans are substantially different. So the original loans should be extinguished. This should be the accounting. Either you have to draft your answer. That's financial liability old should be de-recognized 1985 and the new liability should be recognized 20,000 and the difference to the P&L. You can write with description or with the double entry. If examiner asks, then put the double entry. Otherwise, write with your description. Expense transaction, immediately expense out the transaction cost. That's a transaction cost. And finally, the subsequent measurement should be made with the amortized cost with the new effective interest rate 7%. So you can drop the answer in this manner. Don't worry, you will get this solution as well. Don't worry. Okay, last point. Sir, now listen carefully. What if the requirement number 2? What if the requirement number 2? What is requirement number 2? Requirement number 2 is this. Read it carefully. Assuming the same details as per above illustration, but the transaction costs were actually 800,000 and giving the present value of the new loan, it's 21,609,000. Present value new loan 21,609. So how will the renegotiation or the modification be accounted for by Arian at 31st December X1? Now here is the solution of example part 2. Obviously, the topic is still the loan modification. So very first thing is substantial test, add modification date. So with example part 2, modification date is still same, 31st December X1. Carrying amount of original loan remain unchanged. That is 19,815. 19815, huh? 19815. If the carrying amount of the loan is still same, so the threshold of 10%, it's still same. That is 1981.5. Now it's time to compare the carrying amount with present value of cash flow with new negotiated loan. Done. So what's mentioned here? Assume the same details as per above illustration, but the transaction cost 800, giving a present value of new loan 21609. So simple means whatever the calculation we have made earlier, that is this one, the working, the present value future cash flows. Here they are saying that with this present value negotiated loan, the transaction cost instead of 1200, it's 800. So if we change the value, that's not 1200, it's 800. That's the change in example 2. So value, it's become 21609. And that's 21609 mentioned with this example 2. Mentioned here, new loan 21609. So actually calculated with this way. Okay. 21609. 21609. Yes, the difference is 21609 minus 19815. That is 1794. And this is less than the threshold, and threshold 1981.5. So here, now it's very clear. It's very, very clear. The loan modification, it's not extinguish accounting, but modification accounting, because it's less than threshold. So here the first thing, it's very clear. If something about, if with substantial test, if we identify the difference is less than threshold, so loan modification we will declare modification accounting. So with modification accounting, it's another clear point. What will be the accounting? The carrying amount of financial liability, original financial liability, need to adjust, instead the extinguish. Here, not to de-recognize the previous financial liability, not to recognize the new financial liability. Instead, adjustment need to be made with the existing or original financial liability. What adjustment need to make? What adjustment need to make? The original financial liability need to be increased to the present value of the new cash flows. That means the original liability here, that is 19815. Now here the difference says that you need to increase your liability, because the new liability present value 21609. Increase the liability. So the adjustment here need to make 1794. It's possible that with the new loan modification, the change in the manner, the liability become decreased. But here the case about that liability has now become increased with the new terms. It depends on the negotiation. So what we should do, very simple. We have to increase the financial liability that is original one, with the value 1794. And debit, if the liability become increased, the debit should be profit and loss account. That's P&L should be charge here. That's a point. The first thing. The very first thing. Sir, what about the transaction cost? Listen carefully. What about the transaction cost? Yes. Can you please recall the transaction cost, how to handle the transaction cost? Once we initially recognize the financial liability with amortized cost. Yes, the transaction cost must not be immediately charged to the P&L. Instead, adjust with financial liability. Adjust with financial liability and amortize over the time period. So here, debit. What should be debit? Instead of transaction cost debit, here the financial liability. Debit and credit the bank. The value 800. That is about the transaction cost. It's very clear. So that means carrying amount of financial liability original after modification, immediate after modification. Huh? After modification. Yes, listen carefully. Number one, financial liability original before modification. That is 19815. Adjustment related to modification. Here the modification, here with modification liability become increase, and adjustment about transaction cost, that is minus 800. So the sum become 20809.4. Of course, this 20809, it's the carrying amount at 31st December X1. And subsequently, what you should do subsequently, for example, year end, next year end, 31st December X2. The next year end will be 31st December X2. Huh? Your balance opening, that's 20809. Yes, that interest expense, that should be effective interest rate with original. This is 5.5%. Original 5.5%. Not to change. Yes, interest payments. Yes, interest payments with the new terms. And the new terms, that remains same for part B as well, 7%. 7% apply to the fair value of the loan, and the fair value is still 20,000. And balance end. So interest expense 20809 multiply by 5.5%. interest expense, interest payment 7% multiplied by 20,000. So here is the sum. That is the value 20554. 20554. So the important point is that that's need to describe here the modified loan continued still continue to recognize based on original effective interest rate, that is 5.5% the case, with the revised coupon rate, that is 7%, and that's equals to 20,000 multiplied by 7% is equal to 1,400. That is the point. This is the case about loan modification, but substantial tests qualify for that. It's not more substance, so still modification accounting. If you wanted to know about further, so you can work out accordingly. That is 3. That is 4. It's not the exam point. Yes, that is opening balance, interest expense 5.5, that's 500, that this remaining 3 years now. What should be the ending value? That's equals to total 20,000. This is 20,000. That's all. That's all. This is 20,000. And if you repay the loan, that's minus 20,000. That becomes 0. So this is not the exam point. It's just for the sake of understanding. Huh? Okay, students, that if this point examiner examine with SBR part, so what you will write? Very simple. Assume this is the assumption and this is the answer. If the loan modification is modified instead of extinguish, so the terms of new loan again need to be assessed to determine whether they are substantially different. If the transaction cost 800, present value of the loan is 21609, and to determine if the terms are substantially different, calculate the difference. Here the difference shows less than 10, so you need to mention that less than 10. So the loan is deemed to be modified rather than extinguished. So the carrying amount of liability need to increase. The original liability need to increase. That's debit, credit, all we have done. Transaction costs need to adjust with financial liability, and the modified loan would then continue to recognize at amortized cost based on original effective rate with revised coupon rate of 7%. That is 1,400 per annum. That is all about the example. Students, the last movement of this topic, the last movement. To sum up all the thing, IFRS 9, financial liability is the content, loan modification is the concept. What we have covered, it's all about loan modification it's all based on substantial change test with the threshold of 10%. If substantial change qualify for more than and equal to, it's more than and equal to 10% or less than 10%. More than or equal to 10%, it's called extinguish. It's less than 10%, it's called modification. In case of extinguish, de-recognize original financial liability, recognize financial liability, new financial liability with fair value. Any difference, that's it, just with the profit and loss in alongside any transaction fees. Subsequently, new financial liability new financial liability must account for according to amortized cost method with new effective interest rate. Less than 10% original liability is still to recognize. Original liability need to restate with till the level of present value of revised cash flow in case the loan become increased. Plus the transaction fees that need to adjust here. Any difference is taken to P&L. Subsequently, the modified loan should be reported or account for as amortized cost method with original effective interest rate. This is all about the loan modification. Thank you very much. Jazakallah khair. Assalamu alaikum.